Welcome to Sparta Market Outlook, your go-to source for the latest oil market trends, insights, and strategies. In this podcast, Sparta's team of analysts and experts break down complex market information into actionable, forward-looking insights, helping you make informed decisions in a volatile market. For traders who want to anticipate future pricing trends and seize opportunities before their competition, Sparta provides real-time, actionable market intelligence. For more information about Sparta or to book a demo, visit our website at spartacommodities.com. Now over to your host, Sparta co-founder and CEO, Felipe Sherman.
Hello everyone, welcome back to another episode of Sparta Market Outlook. Today we have with us Neil. How are you, Neil?
All good, thanks.
We also have Philip Jones-Lux, or Phil. I don't know why I call you by your full name, like your mother would call you, but yeah, how are you?
Good afternoon, all good, thank you.
All the way from the US, John Coleman. Hi, John, how are you?
Hey, Felipe, thanks for having me back on.
Excellent, good to see you. And Michael Ryan, I'm an American in Europe. How are you?
I'm good, thank you. Good to be here.
I insist on the American side because obviously we have a very special topic of discussion today, and surprise, surprise, it's the tariffs. Obviously, the big talk of the market right now, and I think we're going to almost exclusively talk about that and the impact that it has on the different markets, whether it's distillates, crude, etc., gasoline to a certain extent, and obviously freight, big impact there as well. But before we even start, I have to say that it feels a bit weird not to be face to face with you guys. We did that last week. I thought it was a fantastic experience. It just feels weird not to be, sitting. Well, the good thing is we removed the tie. That was, next time we do it without the tie. But it feels weird not to be face to face.
You're letting everyone in on the secret that we're not all sat here in suits and ties, actually.
Yes, exactly. We don't dress up just to do an audio podcast. No. But anyway, let's start with the tariffs. Where do we start? General overview, Neil, can you give us that? What happened? What does it mean? What is the immediate impact? Yeah, let's start with that.
Yeah, maybe start with the things we know. So as things stand, the tariffs are in place, right? So it's 10% on Canadian energy, 25% on Mexican energy. There is news, or at least there's headlines from yesterday, right, guys, that maybe there might be exceptions or the tariffs might get rolled back, in another example of the exhausting back and forth as to whether these things will happen. But as things stand, they're in place and we start to put them in our tools, right, guys?
Yeah, so certainly on the distillate and the crude, they're in already. And just when you were saying about the exhausting kind of back and forth, yeah, let's see. By the time this podcast goes out, maybe it's all null and void, but hopefully not.
Yeah. So and then there's going to be counter tariffs from Canada, more to come in the next 3 weeks. As things stand, Mexico to announce theirs on Sunday. Let's presume that they don't shoot themselves in the foot with tariffing the million barrels a day of US products that they import. And markets didn't like it. The kind of same thing as last week, right? So US equities didn't do well. European equities doing very well. Euro up, dollar down. Rate cut expectations are advancing for the US. What else? Flat price on crude is now 69. Hasn't been that in several months. So it's kind of the same message as we said last week. Markets don't really like the uncertainty for a start and the kind of implications that all these tariff has and the trade war has on the macro outlook. I guess we'll talk about the implications on the byproduct basis through the pod, but do we want to just do a very quick round table of the key takeaways? Is it bullish products generally, Phil? Is that a good idea?
Yeah, sure. Yes. But I would say bullish products, it's obviously bearish US refinery margins specifically, and therefore supply. But there are other reasons on top of that to be bullish products. I think, I don't know, Michael, on freight, I would suggest that there are some definite winners and losers.
Yeah, exactly. So just at a high level, it's quite bearish US Gulf Coast freight, and it leans a lot more bullish Northwest Europe freight. I'm already seeing that play out a little bit in freight rates, especially in Q2, and we'll get into it more later, but all of the R margins across the Atlantic Basin have now moved as a result of these tariffs. And I think we're going to start seeing the impact happen in freight balance of this month.
That's specifically on the clean, right?
Specifically on the clean.
Okay, because I mean, I don't know, John, on the dirty side, on the certainly with Mexican crude and fuel oil maybe now heading elsewhere, I guess marginally or on the balance of things, it should be relatively bullish for dirty freight. Is that right?
Yeah, I mean, definitely from a crude perspective, I think, Phil, like you said, there's going to be some regional winners and losers as this plays out. But I think broadly speaking, when you're injecting more costs into the system, it's going to have to push prices up to recover those costs. So you're going to see, broadly speaking, a bullish bend on the crude and / dirty side as well.
Sounds good. And then in amongst all that news yesterday, there was also the OPEC decision that actually kind of went under the radar. So
Yeah,
OPEC,
surprisingly non-eventful,
yeah, well, sort of under the radar. I mean, flat price definitely responded, but strange timing, I reckon. Bit hard to understand. So OPEC are going to raise supply as planned from April, and volumetrically it's not very much, right? It's 140 kbd. It's basically nothing, but it's obviously the sentiment that counts, and they can always pause if they want to. But let's see how happy they are with Brent that's below 70 now, and who knows how far this thing goes in the next month. I've been reading up. There's lots of potential motivations behind this thing. One theory floating around is that the whole group has decided to move to a market share defense rather than price defense for the medium term. I don't really think it matters that much what the motivations might have been this time round. The fact is that that's what they've come out and said, and we know that certain elements of the group want to produce more. So Kazakhstan is producing more, the UAE is producing more, want to produce more. KRG we've talked about. Nigeria even says that they're producing more, want to produce more. So they've got problems from that perspective as well. So all of that not very good for flat price. And it's always about this time that people start to talk about China, the Chinese put. So there was a headline today or yesterday that came out that China is considering accelerating its SPR purchases. So that's always the thing. As soon as flat price gets low enough, you start to think about the Chinese input into the system, basically.
Well, they have done it in the past, so it's sort of the timing. Their timing fits.
Yeah.
And again, it's a potential wake-up call for all the bearish out there. There is a potential floor to the whole market.
Yeah.
Okay, and what else have we seen? So a lot of news around Trump again, Zelensky, Venezuela. All of this is impacting, no, Neil?
Yeah, we can get into maybe we save the kind of Russian story for next week or something when we've got a bit more time. But there was obviously then the Trump is pulling the Chevron license in Venezuela. Instead of giving them 6 months, it's 1 month, and that's another 200,000 barrels a day of heavy crude that goes into the problem that we will talk about later, which is the Gulf Coast really needs heavy resid, and where's it going to get it now? And that's something that John and I will try and discuss in a few minutes' time. And then the other thing, guys, was, as we have said the last few pods, particularly you, Michael, the dam looks to be breaking on Suez. Is that a fair statement?
Yeah, so I'd say every week, if you look into the ship tracking, we're starting to see a couple more ships indicating the Suez Canal. And that is adding on to the two from the week before and the two before that. And it's starting to become not material for volumes, but material for sentiment. As owners start to see more and more ships and more of these smaller shipping companies transit the locks, they're going to be pushing hard to do the same. And I really think that as we get into later this month in Q2, that these transits pick up massively. I think that for ARB econs, really using the Cape economics will start to disappear over the next month or so, and everybody will start to look at the Suez econs again.
And all else equal, that means a new baseline for east-west spreads on crude and products.
Exactly.
All else equal. Yeah.
Yeah.
Yeah, it's just obviously it's very anecdotal, but the conversations that I've been having with customers of ours over the last week or two has certainly been, when they're looking at the platform, they're starting to look more and more at the kind of standard ARB option on the ARB rather than the via Cape when they're assessing those economics. Yeah.
That's the advantage of having someone that is dedicated to this. Now I think we launched just today or yesterday the ability to look at the imports into US with tariffs, whether it's crude or so it was done within a day, and in the same way that we did with the ability for you to look at Cape or Suez, and all of that is done within a day. That's a little bit of publicity, never hurts. But yeah, it's worth mentioning because you guys work extremely hard to make that happen in such a short notice. Because again, we're trying to sell conviction. That's what we do. And obviously, if the numbers are always 1 month behind relative to what the action of the market is, then you don't really have that conviction. But yeah. Phil, we want to move on into the individual products. Let's start with gasoline. What is the immediate impact of the tariffs?
Yeah, so we'll start with the immediate pricing impact. Obviously, so towards the end of last week, when it started to become a little bit more likely that tariff day was going to happen, and then obviously yesterday and throughout today, as the pricing has reacted, the first thing, relatively unsurprisingly, is that RBOB rallied, despite kind of ample Pad 1 stocks that we've been talking about. But yeah, the first thing that happened, RBOB rallied. That seems to have maybe hit a bit of a ceiling already, though, because we had kind of a simultaneous continued slight sell-off on EBOB. So the TA ARB was widening throughout the day quite significantly. It was about 30% higher day on day if you look kind of net RVO. So that was the bit that kind of slightly confused me. We'll go into that in terms of why EBOB was selling off whilst RBOB was rallying. But the net result is a much wider TA ARB now, and that has opened the on both on paper and kind of realistically this RBOB ARB from ARA across into Pad 1, and that kind of makes sense, I suppose. There's something, there's a flow from Canada, specifically from Irving St. John, that is likely now going to be missing. We'll talk about that in a little bit more detail in a second. But the other kind of the first impact, or the next impact that we want to talk about, and Neil and John can go into this in a bit more detail, of the tariffs in terms of the gasoline market, would just be that we would expect Pad 2 and Pad 3 in particular to have maybe lower supply of heavier crudes, of residues, and that we essentially need to debate now and come to a conclusion on whether that is going to mean that they try and keep utilization high, but we get a lot more, or we get more light ends potentially in the margin, or if that overall it's kind of throughput that falls rather than increasing overall light end supply. So we'll talk about that in a second, but I'll get back to, and I think the main kind of tariff implication from the gasoline side is this East Coast Canada, so the Irving St. John output, and what happens with that now. So over the last few years, it's the imports into Pad 1 from Canada have averaged just over 100,000 barrels a day of gasoline, essentially, and that makes up somewhere between 10 and 15% of Pad 1 gasoline imports, according to the monthly EIA data for the last few years. It's relatively good quality stuff. There's alkylate in there, there's higher quality streams. So, on paper, maybe they can go anywhere really, but maybe just not directly into the Pad 1 anymore. So I think at the moment we're looking at two kind of main options for where these Irving St. John barrels are going to be heading. One option, which we maybe still need to investigate a little bit more, and I don't know, putting Michael on the spot here, so I don't want to necessarily do that, but domestic rerouting. So we know that there is a short, obviously, in Canada, in kind of Montreal, the lakes type area. So whether there's a domestic kind of rerouting available there, but Canada has its own equivalent of the Jones Act, which is going to make that particularly kind of expensive or complicated. And the other option would be that actually those flows that would typically head straight into Pad 1 might end up just going into Borco, going into the Caribbean more generally for blending. So that will add, additional timing, additional freight costs to get it there and back. But I think if you can make that work in terms of blending, and then as essentially a workaround, so that that RBOB that is then blended in the Caribs and moves back into Pad 1 is not subject to the tariff, then that seems like obviously a slightly less efficient way of getting those barrels still into Pad 1, but maybe not a huge workaround once everything is kind of established.
Well, you could argue that the other option is just that the prices go up and they still go into the same destination, but RBOB is just more expensive. 10-15% of their normal flow is significant, but a 10% increase, it gets diluted because ultimately, St. John will have to lower its price because you said it. Their alternative, the biggest loser here is St. John, refinery, because
Yeah.
you cannot look at locally because of your local Jones Act. I don't know what's it called. Going to Borco, come on, it's you said that you can go anywhere. The reality is that there's not a lot of places where you can go with high quality stuff sitting in Canada. Going it all the way to Borco is quite expensive. So all in all, my bet is that it's still going to go to the same destination. It's just that RBOB is going to have to get more expensive, and they're just going to have to reduce their margins. When I say they, is the Canadian refiners.
Yeah, I suppose that's then the debate, and it's mirrored in the crude as well, right? It's how much of this has to be swallowed by the refiner, how much of this has to be kind of absorbed by higher RBOB. I kind of think 10% on the finished on the landed value of the cargo is very significant, and I think before I would argue at least that before RBOB kind of rises that much or has to rise that much, it's already pulling in the missing kind of volumes or the balance of that from ARA. When we hit the height of the summer, it's not been unusual over the last couple of years to see components at least coming in from the Arab Gulf. If we have the Suez open again, then there's no reason in the summer why Pad 1 needs to really bid up to the levels that would counter this tariff, when actually there will be components available, certainly in the Atlantic Basin.
No, I'm not saying that your RBOB needs to do all the job. I'm saying that it's going to be slightly diluted because I personally believe that those barrels, maybe not at the beginning, but after 2 or 3 weeks of reestablishing the prices, they will still end up going to New York, and essentially the refinery will take a lower margin. You're going to have more competition from Europe. So, over the last years or so, ARBs from ARA to New York have been, pretty low, or they haven't been very exciting. Now you're going to have that a little bit more excitement there in the market because you're going to be more competitive relative to Canada, and RBOB will be a bit more expensive. All of these three factors. Mm-hmm. That's where your increase in, your 10% will be diluted.
Yeah. Now I think the question is, how long do we expect this to be in place, right? We saw the TAR yesterday and today widened significantly, and that has opened very much so also the ARB for blenders in ARA to blend RBOB and deliver that through April and May. The forward kind of June, July, August is not open yet. So I suppose the question is, how long are we expecting this to remain in place? Do we need to be pulling in significant barrels also through the summer months from Europe? And even if we don't, I think the other thing that I'd be looking at, and if we come back to the short term, is okay, what are the calls now for the next few weeks, right? And I'm starting, and I'm happy to debate this and come to a different conclusion, but I'm starting to get very bullish, also relatively prompt EBOB. So April, May EBOB, for example, it's currently sat essentially at parity. So we've gotten rid of all the backwardation now in April, May. And so with the caveat that apparently there's a lot of material in storage still, every available metric that we have in the platform especially is pointing to a relatively bullish picture now for EBOB. We have this very wide open RBOB. We've got all the swing shorts in the swing kind of destinations that we would look at in the Atlantic Basin, and actually some of them for the prompt loading in Africa as well, opening up for ARBs out of ARA. We've got relatively narrow gas nap, which means blending is relatively expensive for EBOB, and those blend margins are closed, so we should get less finished grade supply. So the metrics that we would tend to follow for EBOB are all looking very bullish, and we've had a bit of we've had a continued sell-off over the last few weeks, so we're at a place that's a relatively low base. So I'm getting pretty bullish EBOB right now.
Yeah, no, I get your point. Look, I think that what happened was that just the market was perhaps too long in March, April, and that there was no longer any bid left, and hence why the market has collapsed, starting with the gas naphtha that was not supported. And when we discussed last week, what we were seeing is that the blend values for April were negative, meaning that the components were too expensive relative to gas naphtha that collapsed too much. Component prices have come off, but still gas naphtha keeps coming off. So it's just this vicious circle. But now that we see this, this RBOB situation, and I think that the ARBs are open now into New York. Yeah, I mean, maybe we start seeing a bottom, and this is the right time. But it depends on what was the length of the market before. If people were already long, and are they getting out, or they're just maybe they're just holding the position and seeing. Yeah, but there was a sort of bullish March kind of scenario and bearish April scenario, and now maybe it's playing the other way around. So it may be catching people off guard.
That's fair. Although, as I said, the very prompt loaders, even because of the way the East-West has been trading, are actually open again into South Africa and East Africa if you really want to try and make that work.
Okay.
But I think I would probably hand over to Neil and John on the crude before we get too distracted on anything else on gasoline.
Yep.
I was going to say your bullish outlook will get nuked when Trump puts tariffs on the EU anyway. So
yeah, exactly. The life of a
come back in a week.
Exactly, the life of a trading analyst or anyone in this market with Trump out there and his access to his phone.
Yeah, we can go to crude though. So maybe just to fill out a quick update on the crude market, and then we can go into the sort of bread and butter of what we wanted to talk about on crude. It's all change in the crude market. So pretty much all the ARBs got flipped on their head. So what did we get? We got TI Brent paper that narrowed 50 cents. I will point out that we did have that trade in mind last week, but not for those reasons. Our reasons were the fact that TI looked very cheap everywhere, but it's just the tariff impact, right? So the market is now pricing, I think, substantial WTI use in the domestic refining system in the US. That's basically what it is. And the other thing that happened was that the Dubai market completely collapsed. So Dubai spreads collapsed, Middle Eastern spot premium collapsed. At last, we've been talking about it for ages, but unfortunately it was, let's say, not going in the direction that we thought it would for quite some time, but now it has. And the EFS has started to gain. So that has flipped everything around. And the result is that light sweet ARBs from the US and from Europe are essentially closed to Asia. Right, John? So TI is closed, Forties is closed, and we had sort of earmarked the North Sea FOB premia to rise already last week because they looked surprisingly weak when you're comparing to things like TFLs. And now it's the same thing on the medium crudes. So Mars is closed to Asia, 2P closed to Asia. I mean, Mars is its own special case, right, because it's being bid up by the tariff impact or perceived tariff impact, but the medium crude situation is the same as well. So I don't really have a trade idea on that yet. To an extent, that's the kind of normalization of the conditions that we're kind of used to, except for the last couple of months when everything was open. But, to a certain extent, it kind of makes sense because in the Atlantic Basin, we're going to be tight. As things stand, we're going to be tight medium sour crude, and we're going to be tight potentially on TI for the foreseeable. And that kind of rolls us into the tariff discussion, right, John?
Yeah, and I think that kind of raises the question of, here we are, tariffs, D-Day +1 at this point. The second day tariffs have been enacted. What have we seen in our data so far? What has the market response been? And I think, there's two sides of that. There's what's interesting is what we have seen in our data, and then also almost more interesting what we haven't seen yet in our data that gives even more discussion points. So I think you touched on it a little bit there, Neil, where you were highlighting how Mars and other Gulf of Mexico grades were effectively closing ARBs everywhere where those grades are pricing to be run domestically. I think the immediate response here is the obvious one that's happening where Gulf Coast refiners are bidding up what is available to them in their own backyard to quickly backfill what is going to amount to be roughly 1 million plus barrels per day of heavy material that has some sort of economic impact from these tariffs. So between Mexico, Canada, and the looming fallout from the Venezuela actions, you're north of 1 million barrels per day of heavy material that was going into Gulf Coast refiners. So the first action there is obviously going to be try to secure those medium sour type barrels out of the Gulf of Mexico, and we've seen that in spades where prices there have moved $1 to $2 pretty significantly, basically overnight. Same thing with pricing for Canadian heavy crude in the Gulf Coast, which is I guess not unexpected, given it has a lighter tariff effect to it, but it is going to get pulled up alongside everything else. As you know, these Gulf Coast refiners, they have the decision that they're going to be faced with is ultimately finding a way to maximize their downstream upgrading units, their coker feed that needs to be replaced, with balancing the additional costs of those tariffs.
So, John, just to sound like, to lay out the problem in very explicit terms, Mexican, Canadian, Venezuelan is super heavy, and it's not a like for like replacement, even if you got your hands on other types of LATAM crude or Middle Eastern crude or some WAF and stuff like that. So the problem is, even if they find volumetric replacements, they're going to struggle to operate properly. Is that a fair thing?
Yeah, I think you're kind of hitting the nail on the head here. So the interesting thing that we saw in the data was, Gulf of Mexico prices screaming higher. I think what is, what we're waiting to see, maybe that we haven't seen yet in our data, is where further afield Gulf Coast refiners are looking to secure as close to like quality barrels as they can. So we're waiting to see the impacts on, LATAM heavy grades. Looking closely at Colombia's Castilla grade would be a obvious choice, but the challenges there are a lot of those barrels are going to be termed up. So it's really unclear how much is readily available to backfill a lot of this. So the other interesting point, I think, is you haven't yet really seen the full brunt of the tariff hit local Canadian heavy prices. So in Hardisty, we've only seen prices move somewhere around $1 or so since the tariffs were enacted, which is, $4 or $5 short of what we would expect it to be. We think that there's probably still a lot of room for that to move. Part of that could be attributable to the uncertainty in communication around these tariffs. Just given yesterday, they said there might be a deal struck today, as we, highlighted earlier. So maybe a little bit of cautious buying happening there, but certainly more to play out in those pricing. But the point you make, Neil, there is that finding like for like heavy material that can fully maximize the downstream units these refineries were built to run is going to be a problem. And when you think about it, swapping in a medium gravity barrel or even a very light barrel like WTI, it's going to create run rate issues where they simply can't run at nameplate capacity to fully utilize their system as designed. So until the market can kind of reoptimize and reorient other heavy material towards the Gulf Coast, you're going to see some inefficient refinery operations probably out of Fad 3.
Yeah, and we've been talking sort of internally about the Middle East as one target. So as you're going to get Mexican stuff heading to Asia rather than Europe, probably given the quality, in theory you want to free up some LATAM that typically goes to Asia or even Middle Eastern stuff, but it's not so easy to displace Middle Eastern stuff because it's termed up. What you can do is reduce your nominations, and then slowly you can kind of adjust your term agreements, and slowly this thing starts to turn. And it's the same thing with the HSFO market, right? High sulfur fuel oil, which typically goes to the Gulf Coast as well out of Mexico. You need to try and source alternative barrels there. So it's the same type of story. Do the Mexican barrels go to Europe and release sort of very small streams from all over the place in Europe, and it all goes to the Gulf Coast? Or do you start to pull in some Middle Eastern barrels? Or do you send maybe Mexican barrels to the Caribs and reblend it and send it back to the Gulf Coast? It's all very costly. It probably takes time. And before this, I'm a subscriber to the fact that if the oil is there, it will optimize itself nicely, but it's going to take weeks potentially. And in that time, you might end up with lower runs, which has got your impact on products, guys. And also you might end up using more WTI. And that's why the TI Brent spread has now gained or narrowed 50 cents. And maybe that's a reasonable price move for the very short term, but not a reasonable price move for in 1 or 2 months' time. That might be a fair statement, right?
Yeah, that's really, 50 cents on that paper spread is quite significant. And when you think about, the potential disruption to WTI needing to clear into the global market because it's remaining home in U.S. refiners, there's two real ways to think about that. In Pad 2, we haven't talked much about that. That's a region in the U.S. that's going to see some pretty gnarly effects from these tariffs and how they choose to optimize their systems there, because really there's no logistical solution for them to source alternate global crudes. So it's really down to their typical crude slate of about 60% Canadian grades, 40% domestic WTI-like qualities. The question might be, can they shift some of that Canadian out in favor of marginally some additional WTI? The answer is probably yes, but again, you come down to situations where it's going to create inefficiencies in the refining system that probably end up with lower run rates. So I think across the board, you've got a lot of questions on how much WTI can really realistically be absorbed. I think in the first month or two, that is going to be an obvious solution where refiners try to get what they can where they can in their own backyard that's not tariffed up. But ultimately, it's going to pull prices and market equilibriums to a place where it's going to be solved through a balance of either running the tariffed Canadian barrel or running less. And that's the trade-off that they're going to make. So there's obviously ramifications into product supply and just the lightening of the crude slate. Like I think Phil mentioned earlier, potential more light distillates into the market at the expense of potential diesel supply and diesel quality are big questions in our minds. So well, I get the market's initial knee-jerk reaction on the paper spread there to immediately tighten that Brent TI spread. It's possible that the amount the market's pricing in terms of how much is being consumed domestically might have been a bit of an overreaction versus what's logistically and realistically possible.
To play a a real devil's advocate here, I think it's something we've discussed briefly offline as well. Would be a really great time for Pad 3 to have access to those Russian molecules, right?
Phil, you lambasted me a few weeks ago for suggesting such a thing. But
I did. You're right. I know. But the world is a strange place, Neil. Things that I thought were not possible 6 months ago that are happening on a day-to-day basis now. And
on a serious note, there are headlines floating around that the US is seriously considering dropping Russian sanctions, right?
I would echo that. Like, if you asked me that question a week ago, what probability I would ascribe to a Russian barrel being run in a U.S. refinery this year, I would laugh at the thought of that. But, just given the speed at which these events are playing out and the rhetoric coming out of the White House, it's not an inconceivable thing that Russian volumes, whether it be crude or some sort of intermediate residue, could step in to help alleviate some of the constraints that might emerge here for some U.S. refiners.
And I mean that was historically a pretty kind of reliable flow, right? The M100 type stuff going into the Gulf Coast, yeah.
Absolutely.
Yeah. And something like 200 kbd of Urals. If I might be totally out of the woods there, but I think it's
no, but
similar.
the VGO trade was a classic. It was all of that Russian VGO going for gasoline production in the Gulf Coast. That was a classic trade. And yeah, I mean, it's as crazy as it sounds, it's tariffs to the neighbors and removing tariffs to Russia. 2 weeks ago it would have been inconceivable. Now it's maybe a reality. But John, I want to go back to your sort of summary of they either find a solution, or they cut. And right now, some of these refineries, there really isn't any solution. There's going to be tremendous amount of inefficiencies because they only have light crudes. Maybe you start having again that flow of, AG crude going to the US, which was almost inexistent. But in the past, it was the main supplier. That maybe is a trade. Very surprising, but let's see. But if the question is either shutting or not shutting, just reducing throughput because of the economics, or bringing in alternative crudes that are from very far away, what do you think is going to happen?
Yeah, I mean, I think you make a good point there on AG kind of backfilling some of the needs here. I think that's ultimately the backstop that Gulf Coast refiners are going to turn to, where to find enough heavy material, that's going to be the source that can pull together enough volumes for them to to meaningfully run at somewhat normalized, run rates given their configurations. But I think it's obviously going to be an individual refinery by refinery situation. Like an interesting case study is going to be the Deer Park Refinery in Houston, Texas, which is a Pemex-owned facility. Pemex being the national oil company of Mexico. That is the primary importer of Mexican Mayan crude. I think more than half of their crude slate is Mexican Mayan crude, and probably they don't have an immediate ready backfill. So either they're paying the 25% tariffs on that and nuking their margins, or they're scrambling to see how much WTI they can fit into their system and still run as hard as they possibly can. So each individual refinery right now is trying to say, how can we max out our light processing and then fill in the gaps as we can until we can get a better visibility on heavy supply available to us, which, like you pointed out there, is probably going to be an AG solution at the end of the day.
Sorry, you said 25%. Is it 25 or 10? I thought it was 10%.
It's 10% on Canadian energy, 25% on Mexican energy.
Okay.
Yeah.
So, I mean, and then the implication that it has on products. Because here we're talking about San John Refinery going to New York. That's the obvious one. And because it's a direct finished product going to the pricing center, it obviously has an immediate impact. But if I extrapolate what you're saying about all of these PAD 3, PAD 2 refiners that are now making a choice between I increase my prices and I pass that along to the customer. I reduce my throughput because I simply cannot have, I only have like super light crudes to run. And even if I bought these, AG crudes, that's maybe in 3-4 months where all the logistics gets, so they're just going to have to maybe reduce the throughput. That's going to have an impact on gasoline production. It's going to have an impact on diesel production, which then has an impact again because mainly on PAD 2. PAD 2, you're sort of, in the middle of nowhere. I mean, sorry, you live in PAD 2 area. Yeah. You don't live in the middle of nowhere. But what I mean, in terms of you're landlocked and you have your steady supply of crudes, you have your great refineries, but, you don't have a lot of flexibility. So that means the flexible one is PAD 3 that will have to do the job for PAD 2. It gets a bit messy, and all of that will ultimately have an impact on PAD 1 gasoline or PAD 2 gasoline diesel as well.
Yeah, you're right. It'll be an interesting trade-off, especially in PAD 2. Yeah, it is my backyard, so I'm watching the story quite closely. But so if they do lighten that crude slate, obviously that shifts it's at the margin going to shift your yield profile towards a lighter distillate production profile. You'll yield more gasoline, but if because you're lightening your crude slate, you can't run as hard, you're producing less product overall. It's going to see how it'll be interesting to see how that balances out on the gasoline side. I think the real question is going to be on the distillate side is you're simply just not going to have enough distillate range material to make current supply levels. So it'll be really interesting to see how that plays out, not only in PAD 2, but PAD 3 that does have that flexibility, but is probably going to take, like Neil mentioned, weeks, maybe even months to really sort out the trade logistics to normalize their operations.
Yeah, I have a bit of a different view on PAD 2. I just think WCS diffs are going to go through the floor, and that'll be that, because it's landlocked crude. It can't do anything. And
it'll be a good academic discussion once all this is in the history books. I think the challenge to that would be that is PAD 2 itself, because they have no other options. There could be leverage from Canadian producers to extract some of the burden of the tariff onto them. But I see your point. It could just be, if it falls entirely on the Canadian producers and it discounts into the Canadian price, there'll be a minimal impact on PAD 2. But I think, in my opinion, there's probably going to be some sort of sharing between those two groups of that burden.
Yeah, and then on Maya, just want to point out the margin on Maya is still positive in the Gulf Coast, even with all the tariff. So it will be some kind of optimization, particularly in the short term, between how much TI should I put into the system. It's got a better margin, but it's going to reduce my run rate. There will be some kind of equilibrium there, even in the short term. So it's difficult to know.
Agreed. A lot of moving pieces here.
Okay. What's next? Distillates?
Yeah, well, let's wrap up going through the tariff impacts quickly. Still going back to, or I sound like a broken record today, but going back to St. John, then obviously that ARB is something that we capture in the platform as well, and that is extremely closed now. It's interesting to see that for kind of March loaders through the last week of February, the ARB into New York was better than the ARB into Europe, and now obviously that the tariffs are in place, there's absolutely no debate. Those should be heading to Europe, and just today we've seen 2 cargoes diverting that were on their way to Pad 1, but have diverted across the Atlantic on the back of the tariffs. So that is all kind of playing out as expected. The question now is, where does the backfill come from for Pad 1? Whether that is, Colonial Pipeline being maxed out, but that's a relatively, so maybe we just kind of continue to see winter levels of completely maximizing your distillate capacity in the Colonial Pipeline continuing into the summer. But overall, it looks as though the HOGO has reacted to an extent that the cargoes coming into the Atlantic Basin from outside, so the stuff that's coming in maybe from the Middle East, now has essentially a choice to make whether it can or should divert across the Atlantic Basin, and that's probably the relatively easy kind of fix there, in terms of, obviously we've got 100 kbd roughly of Canadian diesel that's now missing from Pad 1, but that's I would argue kind of a relatively easily, efficiently replaced source of barrels for Pad 1. Elsewhere, I think the bigger impact is then obviously on the US Gulf Coast. So what we were talking about in terms of the potential impact on run rates out of the Gulf Coast, and the broader kind of play now between, obviously we have a wider HOGO spread, which should be moving to shut that Gulf Coast into Europe distillate ARB. But on the other side, we've seen already the spread between the Gulf Coast pricing and the pricing center. So the US Gulf Coast swap diff to heating oil widen to kind of counter that a little bit. TC14 coming off. I think Michael, you were saying anyway from the gasoline side, we would expect TC14 to weaken. It looks probably the same on the distillate to help keep that ARB open, right?
Yeah. So I really think the Atlantic Basin flows will change materially if these tariffs hold. So what you're talking about with East Coast Canada and out of the US Gulf Coast really rings true. So if you take the classic triangulation for CPP products out of the Atlantic Basin, you have diesel cargoes moving from US Gulf Coast into ARA, and then you have gasoline moving from ARA into USAC. And I was looking at ballaster counts earlier and laden counts out of the US Gulf Coast heading to the continent are 45% lower than a month ago and almost 60% lower than this time last year. So the number of vessels carrying product from the US Gulf to Europe is much lower. Mm-hmm. So that mainstay of triangulation is starting to dry up with all of the ARBs being shut. So now what you might see is you might just see a back and forth between ARA and USAC. So you've got gasoline coming into the US from Europe, and then you have diesel backhauls going from East Coast Canada back into Europe, rather than that diesel coming from the US Gulf Coast into Europe. So that's just one of the many trade flows that I think could be heavily impacted here. Equally, with all of the ARBs now shut out of the US Gulf Coast relative to, say, the European pricing center, there's really nothing for all of these MRs to do when loading out of the US Gulf Coast now. So they're all doing these sort of short haul Caribbean runs, and it doesn't do any good for the tonnage lists, because as soon as that vessel starts discharging, it appears on the tonnage list again, because it's only a 5 to 10 day voyage back into the region. And then reversely, now you have European cargoes pricing a lot better into LATAM, and those voyages are much, much longer. So I think the trade going forward, again, as long as these tariffs hold, is there's really no reason for spot TC14 rates to roll up to where Q2 is. I really think Q2 is going to start rolling down to where spot is, so down into close to the 80s now in world scale. And then also for TC2, it just seems undervalued, given that Northwest Europe could become a much more material provider of CPP products into, say, LATAM compared to its closest competitor, the US Gulf Coast. There should be that much more demand for freight out of the region.
Yeah, I think that makes sense, and it resonates with what we've said on the gasoline, and it obviously makes sense now on the distillate as well. So, okay, I would just kind of wrap up on the distillate quickly, just to say, the last week or two, we've seen ice gas oil cracks and spreads coming off even prior to the tariffs, and maybe there's a link there to some things that we've been talking about in the pod previously, but also now actually that one of my kind of pet favorite stories on nat gas prices being very high, they've come off on warmer weather returning to Europe and good renewables generation over the last couple of weeks. So everything was kind of pointing towards a little bit of a more bearish picture for gas oil, including the fact that it seems, everything's moving around very, very quickly at the moment, but for now at least it looks as though Gulf Coast is still pricing to try and keep that arb open into Europe. And the other aspect of that is, as we said right at the beginning of the podcast, that the Suez route looks to be opening up, right? And that's on a kind of baseline level now, making the arbs out of the Middle East, making the arbs out of West Coast India much more workable back into as a kind of baseline feed into Europe for gas oil. So for a while now, there has been a very heavy reliance on arbs coming in from the Gulf Coast, and we've seen a very kind of immediate impact on the gas oil complex as soon as the Gulf Coast arb opens, kind of almost suggesting that the gas oil complex was being almost oversupplied when the Gulf Coast arb opened. Now, if the alternative is looking even cheaper, or if it's more of a kind of comparable now option to really come out of further east than the Red Sea, so stuff out of the AG, stuff out of West Coast India, then I think overall we're looking at just a slightly lower kind of baseline for ice gas oil now, with the caveat that we're talking about potentially fundamentally lower US supply. So we've got kind of a balance there, I suppose. Maybe we're tightening the Atlantic Basin with maybe some lower runs.
It's a different timing. Short term, probably a bit more bearish. Mid-term, we might have to monitor what's happening in the US, particularly if the yields come off, or as we were discussing with John. But let's see.
Yeah, it probably takes two or 3 weeks before you get to see the data in the US, where anything's actually coming out in the weekly data.
Yep.
Yeah. So I think distillate short-term bearish, and we'll see. We'll have to see what the
and besides, and this, Canada. I think there were already 2 or 3 cargoes that were going from Canada to the US or to New York that are now being rerouted and going to Europe. That's going to add a bit more pressure. And unlike gasoline, coming back to your favorite refineries, and John, where with gasoline, because of the quality they produce, it's not so obvious the alternative. Whereas with diesel, it's very obvious. The alternative is, if it's not New York, it's going to be immediately ARA. It's a no-brainer.
That swings sometimes without tariffs as well. Exactly. Yeah.
Yes, exactly. So it's that's going to be the loss there for the refinery is minimal relative to what you will expect with gasoline, etc. So that's sort of a bit more short-term pressure on distillates. If you add the collapse on TTF, the collapse on nat gas in general. Yeah. Okay. Anything else that we need to add here for the tariffs and all that? Just maybe the caveat that everything that we said today may be completely and invalid in 24 hours because everything has changed again.
Yeah, by the time we publish.
Exactly.
It'll Yeah.
So hurry up, trade, get in and out, and hope for the best. No, okay. Thanks, guys. Good to see you, and I'll catch up next week.
Thank you.
Cheers.
Great.
Take
Thanks
care.
for having us. Cheers.
Thank you for listening, and we hope you enjoyed the podcast. For more information about Sparta or to book a demo, visit our website at spartacommodities.com.